You may know that you want or need to start investing, but you might feel overwhelmed by all of the information that is out there. In today's video, I'm going to be going through investing in a very beginner-friendly way and making it really simple for you to understand the steps that you need to take to start investing. We're going to be focusing on investing in ETFs or index funds in this video, purely because that keeps the fees nice and low and lowers your level of risk while still keeping returns really nice and high. So by the end of this video, I want you to feel really confident about starting to invest. And as I said, I'm going to cover all of the steps that you need to do to be able to invest. If you have already made some of those steps and you want to skip over to the next bit, there will be timestamps in this video so you can simply skip forward. First step is to open up an investing account. Now in the UK, you can open up something called a stocks and shares ISA. It's sometimes called an investment ISA, and this is the most tax efficient way of investing. So I would suggest you look into opening up one of these rather than simply a general investing account. The reason that a stocks and shares ISA is better is because you're not going to pay any tax on any gains or capital gains that you are making when you are investing, and you can put up to £20,000 into an investment ISA or stocks and shares ISA every single year. The equivalent of this is a Roth IRA in the US. In the UK, if you have got more than £20,000 that you want to invest every year, which is absolutely fantastic if you do, and you're a couple, then you could both open up a stocks and shares ISA. Now, obviously there are other tax efficient ways of investing. So for example, you could open up a self-invested personal pension, which you would use as your pension into retirement. But for today's video, I'm going to really be focusing on investing in a stocks and shares ISA. But I do have other videos available on self-invested personal pensions if you want to check them out. So when you're choosing a stocks and shares ISA, there's three factors that you really need to consider. And the first one is that it's an established company and it's FCA regulated. The second one is that the fees are really low, because fees really do compound over time, and you don't want fees eating into the money that you are making through investing. And then finally, you want to check that your stocks and shares ISA has a good variety of different investments available. Now, I just wanted to point this out because if you were to go with a provider like, say, for example, Vanguard, with a Vanguard stocks and shares ISA, you can only invest in Vanguard investments. So obviously you are more limited if you go with something like a Vanguard ISA. Now, I do have a separate, much older video which goes through different investment ISAs if you want to check that out. What I will say is the companies that I'm currently using are AJ Bell for my self-invested personal pension. I use Barclays Smart Investor as a stocks and shares ISA, and I also use Trading 212, and I have a stocks and shares ISA with them, because you are not limited to just having one stocks and shares ISA anymore. You can open up one with many different companies, even in the same tax year, as long as you're not going over that £20,000 threshold. It's important to note that I'm not sponsored by any of these different companies. These are simply the companies that I'm currently using. I'll pop links to them in the comments down below. And if you use the link to Trading 212, which offers commission-free investing, if you open up an account with them and fund that account using the link down below, you'll get a free share up to the value of £100. It's really important to mention that when you are investing, your capital is always at risk. So please always do make sure that you feel confident in investing before you get started. Okay, that's the first step done. You've opened up a stocks and shares ISA and you have no idea what to invest in. Now in this video, I am going to be focusing on how to select index funds and ETFs that you want to invest in. The reason why we're focusing on index funds and ETFs is simply because historically they have been shown through research to perform much better than actively managed funds, and probably will perform much better than if you are to pick individual stocks and shares yourself. So research from Spiva, or SPIVA, shows that over 15 years, 87.98% of all large cap funds underperformed the S&P 500. So that means that almost 88% of actively managed funds underperformed the S&P 500. So that means if you invest in an index like the S&P 500, you are much more likely to do better than had you invested in an actively managed fund, or if you're going away and picking different stocks and shares yourself. Now you might be thinking I'm talking a lot of jargon and you're not even sure what an ETF is. So an ETF stands for Exchange Traded Fund, and this is simply a basket of different stocks. So rather than investing investing in one stock of Apple, which might be doing well today but drop significantly tomorrow, you can invest in a basket of different stocks. So you might be invested in, say, for example, the S&P 500, which I was just talking about, which by making a single investment in an S&P 500 ETF, you're actually investing in 500 different stocks and shares. So you're investing in the top 500 US companies when you invest in an S&P 500 ETF. So when you invest in an ETF, you are getting a much more diverse portfolio than if you were going away and choosing, say, 10 or 20 different stocks and shares yourself. You are also getting them at a very low cost. So ongoing charges for ETFs or index funds tend to be very, very low because you're not paying someone to actively manage your investments, as index funds and ETFs are a form of passive investing. So the fees are nice and low, and you're also getting a diverse portfolio without having to put much effort in. Okay, so the next step, which ETF should you be investing in? Now, if you're an absolute beginner and you don't want to be going away and doing a lot of research, then one of the best ETF investments that you might want to make is a FTSE All-World ETF investment. So when you invest in a FTSE All-World ETF, you are getting thousands of different stocks from across the whole world. So that means not only are you getting developed market stocks, you're also getting emerging market stocks. And as I said, this is across the whole world. So let's have a very quick look at Vanguard's VWRL FTSE All-World ETF. So over 62% of this ETF is currently made up of US stocks, and then the next category is Eurozone and then Japan. As I said, you're getting developed market stocks, so you're getting 92.39% are developed market stocks and 7.61% are emerging market stocks within this ETF. So when you are investing in a FTSE All-World ETF, if you have a look at the top 10 holdings, they are likely to be companies that you will have heard of. So the biggest holding in a FTSE All-World ETF is likely to be Apple, and then the second biggest holding is likely to be Microsoft at the moment. Then you've also got other well-known companies like Amazon, Meta Platforms, and Alphabet, which is obviously Google. So 5-year annualized returns for this FTSE All-World ETF are 10.21%. So that means that every year, on average, over the last 5 years, this ETF has risen in value by 10.21%. So obviously with investing, you've got to understand that that is not a straight line up, 10.21% every single year. You will be seeing peaks, and then you'll also be seeing troughs in the performance of this ETF. But if you were to take the average, it's 10.21% every year for the last 5 years. And if you had invested £1,000 into this ETF 10 years ago, your £1,000 would today be worth £2,786, and that's without making further deposits into this ETF. Okay, so VWRL is the income generating version of this FTSE All-World ETF. Now, income generating simply means that dividends are paid out to you. But what I personally want to be doing is, instead of having an income generating ETF, I personally prefer to have an accumulation ETF, which simply means that dividends are reinvested into that ETF so that can compound over time. So there is an accumulation version of this Vanguard FTSE All-World ETF, and that version, the code for that is VWRP. And then for clarity, to let you know that the FTSE All-World ETF that I'm currently invested in is the Invesco FTSE All-World ETF. So the code for that is FWRG. That is an accumulating ETF because that is my preference. And the reason that I went with the Invesco FTSE All-World ETF is simply because the fees are lower than the Vanguard ETF. However, the Invesco FTSE All-World ETF has not been established for as long as the Vanguard ETF has. So if you're interested in an ETF that has been established for longer, then potentially the Vanguard FTSE All-World ETF would be a good option for you. Okay, so by investing in that one single ETF, you already have a very, very diverse portfolio. However, you can look at investing in other ETFs that have historically produced higher returns. What it's really important to mention with ETFs and investments in general is that past performance is not indicative of future performance. Now, you will see that written everywhere when you are looking to invest, and that is simply because because it is the case. You can't just look at past performance and presume that you will continue to make that kind of money, because unfortunately that isn't the case. Sometimes I wish it was. But there are some ETFs out there that have performed historically better than the FTSE All World, but you are not getting the same diversity that you are with a FTSE All World. So I enjoy investing in a FTSE All World, but if you want to have a look at other options, then you could look at investing in an S&P 500 ETF. So most of the big ETF providers will have an S&P 500 ETF option available to you. So Invesco, iShares, Vanguard will also have an S&P 500 ETF available. So have a look at which one works best for you. At the moment, I think one of the cheaper S&P 500 ETFs is the SPDR S&P 500 ETF. The code for that is SPX5. And that is a distributing or income generating ETF, and the ongoing charges for that ETF are just 0.03%, so really nice and low. So let's have a look at the performance of this ETF. So it's 5-year annualized returns, which, as I said, over the last 5 years, this will be the average return every year, and that is currently 13.71%. So as I said, much higher than the FTSE All World. However, what you are getting with the S&P 500 is simply US stocks. So you are cutting out the rest of your world investments. So you will have a much less diverse portfolio, and therefore a portfolio that is potentially more volatile and higher risk. Okay, so let's look at niche or specialist ETFs now. So you might be interested in a specific sector or a specific geographical region, and with ETFs you can invest in those as well. So you can look at specific sectors. Rather than having a very general FTSE All World ETF, you could really hone into a specific sector without having to buy those individual stocks and shares for that sector. So you're still getting a basket of stocks, but you're likely getting a much smaller basket of stocks that's more specialized. So just to give you a very quick rundown and some ideas of some niche ETFs that are available, you could invest in something like a technology sector ETF. An example of this one would be IITU, which is the iShares S&P 500 Information Technology Sector ETF. So the S&P 500, as I said, is those top 500 US companies, and what this ETF does is just take the information technology sector stocks from the S&P 500. So you're not getting those 500 companies, you're getting just the technology sector stocks within them. And that has historically performed very, very well. Again, past performance is not indicative of future performance. So the 5-year annualized returns for the IITU ETF are 24.01%. So very, very high returns. However, it's really important to say that when you're investing in this ETF, it is much more volatile and much higher risk than investing in something like a FTSE All World ETF. So yes, you may see higher returns, but you are certainly seeing higher levels of risk. And if you're a beginner investor, fluctuations in the market can make you feel particularly nervous. They do make me feel particularly nervous. If you want to get a good idea of the risk level of all of these different ETFs, it's good to have a look at the standard deviation. So that will give you an idea of the risk level. And where all else is the same, what you're looking for is a lower standard deviation. The lower the standard deviation, the lower the level of risk when you are investing. Obviously, risk is always involved with investing. So let's have a look at the standard deviation of this tech specific ETF now. So the 3-year standard deviation for this tech ETF is 19.73. Whereas the 3-year standard deviation for Vanguard VWRL is 10.19. And obviously these can't be compared directly because they are very different ETFs, but you'll see that the standard deviation for a FTSE All World ETF is significantly lower than the standard deviation that you're getting for niche ETFs like the technology sector ETF. Now, what I will say is that I prefer to have niche ETFs as satellite investments, so smaller investments than I would, say, for example, having something like a FTSE All World. I'd rather have the majority of my portfolio made up with an ETF like that than I would having the majority of my portfolio made up of just a tech ETF. So there are so many different niche ETFs that you can look at if you want to in a bit more detail and do your own research. Some semiconductor ETFs have done particularly phenomenally well recently. You can also get ETFs that screen for things like ESG, so that's environmental, social and governance. So you can do ESG investing with ETFs. You can also get something called an exchange traded commodity, where you can invest in, say, for example, silver or gold through an exchange traded commodity as well. So there are so many different options with index funds and ETFs. There's actually thousands of different ETFs and index funds to choose from with different platform providers. But what I will say is the most diverse ETF that you're going to get with low fees is something like a FTSE All World ETF. And it's a great place to start. Which leads us on to our final step, and that is deciding when to invest. And what I will say is the best time to start investing is today. And the reason why that is because if you are choosing to invest over the long term, which if you are investing, I would suggest you're looking to invest for at least 5 years or more. If you are looking to save for something where you need the money in less than 5 years time, I would say to put money into a savings account, something like a high yield savings account, or something like premium bonds, simply because you can't guarantee that in 5 years time you'll be able to get the same amount of money out. However, if you leave your investments to grow over time and with patience, they can do phenomenally well, but they will need that time to grow. Obviously, there are certain years where they do exceptionally well, but if you are investing monthly over a good amount of time, then you can really ride out the peaks and troughs that you will see in the market. And when they're doing well, it's a phenomenal feeling, and when they're not doing so well, it can make you feel quite nervous. But if you are investing regularly on a monthly basis, you're actually buying those investments, those ETFs or those index funds at a sale price almost, because they are cheaper than, say, for example, you bought them for the last month. But over time, the value of them will grow and they will gain value over time. As always, pop any questions that you do have in the comments down below, because I do try to get back to every single person that writes a comment. If you have found any value in this video, I'd love it if you would like it, and I would like it even more if you could subscribe to this channel. Thank you so much for taking the time to get to the end. It's always appreciated, and I hope you have a really lovely day. Bye bye.